You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. And speaking of that expansion, if you haven't had a chance to check it out yet, I encourage you to run, not walk, over to the App Store of your choosing. The Google Play App Store, of course, the iOS App Store, even the Amazon Kindle Fire App Store, and look for the Options Insider Radio Network mobile app. You can, of course, stream and download all of the episodes of Volatility Views from there, as well as all of your other favorite programs from the network. You can stream them from anywhere. You can download them and save them for offline listening on a subway or on a train or on a plane, wherever you like to listen to our fine programs. Again, that's in the Google Play App Store, the Amazon App Store, and the iOS App Store. Just search for the Options Insider Radio Network mobile app. I think you're going to like it. And I'm going to be joined a little bit later by my usual co-host, my partner in crime, to break down the realm of volatility. That is one Mark Sebastian. But before we do that, I'm going to dive right into our Volatility Viewpoint segment because we have a great guest in store for you.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. If you're just tuning in for the first time, this is, of course, the portion of the program where we welcome on guests from throughout the world of volatility research and analysis and trading, and proceed to pick their brains for the benefits of you, the listener. And today's guest is actually a returning guest, but it's been quite a while since he's been on the program. He is Chris Cole, the managing director over there at Artemis Capital Management. Chris, welcome back to the program.
Thank you for having me.
Well, we're glad to have you back. Like I said, it has been quite a while. I was looking it up before we started the program, and I believe your previous appearance was way back. This is actually, now that I think about it, this is actually episode 100, so you are on a somewhat historic episode here, Chris. And,
wow, I'm honored, so that's great.
The last time you were on was actually all the way back in episode 33, which was from December of 2011, so well over 2 years ago, back in the very, very early days of Vol Views. So we're glad to have you back on the program, Chris. Since it's been so long, we've had so many new listeners come into the show since your last appearance. Why don't you go ahead and give us a quick overview of your background in the volatility space and how you found your way over to becoming the MD over there at Artemis Capital Management?
Yeah, no, it's great to be on the show. Artemis Capital is a firm that specializes in trading VIX futures and VIX options. We specialize in crisis alpha, which is an idea of trying to make money for our clients when volatility is high or when vol is changing. Artemis is a private investment partnership, and we manage money for individuals, high net worth, and institutions.
And I like the name Artemis, the huntress from Greek myth. So can I assume then you are out there hunting volatility? Is that what that implies?
I suppose you could put it that way. Yeah. A lot has changed since the last time I was on the show. I mean, it's been a completely different volatility environment from the past 2 years. I mean, back in 2011, we were facing what was really a bull market in fear. And today, I think we're in a bear market in fear.
Yes, I think that you're right. It has evolved quite a bit. Why don't we dive into it there then? Your approach to vol over there at Artemis, because we have a lot of people on the show, as you might imagine, who use vol in a lot of different ways. Some trade vol directly. That is indeed the purpose of their fund. They're doing some vol arb between a variety of different products, or maybe they're using straddles in one versus the other to try to capture that quote-unquote pure realized vol. Some may be using more of the implied type products like VIX options and VIX futures and trying to gain the term structure there. Some may be using the volatility products as a kicker for some direct hedge for their portfolio, and let's say an S&P put spread or something like that. Or some may be using it just vol as a hedge. So there's a lot of different ways you can incorporate vol into your portfolio. So what is the approach over there at Artemis? Are you more directly concerned with actually trying to arb that vol and capture those differentials?
Well, it's hard to speak specifically since I'm a private investment pool. It's hard to speak specifically about the exact strategies that I employ at Artemis.
There's no one listening, Chris. It's just you and I here on the show. So you
yeah,
can go ahead and divulge your innermost secrets.
But at the core, I think one of the things I can really talk about is my philosophy on trading volatility. One of the problems with being a vol trader, and I think we do a great disservice to the asset class of volatility, because we tend to group, and allocators tend to group volatility players in one of two categories. You're either this short volatility guy who's going to pick up pennies in front of the steamroller and eventually have really great Sharpe ratios, really great returns until one day you blow up. Or you're this tail risk guy who's just going to bleed and bleed and bleed and bleed until the world ends. So you're either in one or either of these camps. The problem with viewing volatility this way is that it's doing a disservice to the asset class. There is a concept that you can find inexpensive vol and arbitrage that against expensive volatility and do it in a framework where you're balancing your long exposure or your short exposure to meet specific goals, whether that be hedging or alpha. And I think a smart manager is always looking to play volatility on a relative value framework, as opposed to just being on one side of the definition or the other. And I think to the extent that we can begin to think of volatility as a real asset class where you can arbitrage out these inefficiencies, I think that's the way that I view it, the philosophy that I look at vol. And I think the way we need to look at it going forward as this evolves to become one of the most important asset classes in the next decade.
That's actually a good point. You're right. There is kind of this dichotomy to the way volatility and volatility traders are portrayed. Some of that undoubtedly due to the popularity of Taleb's books about Black Swan and all that stuff about tail risk. Tail risk has kind of just captured the imagination of the market, hence this ridiculous amount of premium going into these puts on a regular basis. We also see things like CNBC and others constantly beating the drum for this fair gauge type concept. And so you're right, it has kind of, I guess you can say, stratified the volatility landscape a little bit into either you're into one camp or the other, when there clearly is a middle ground, and it is a profitable one that you could stay in for quite a while, and you don't need to be blowing out a bunch of premium and then rolling the dice that way, or just loading up on 5 delta puts and waiting for the end to come.
Absolutely.
So you mentioned a lot of your research you have working over there. I know in the past you wrote a lot about that quote-unquote bull market in vol. We had a brief return, it seemed like, of the bull market in vol a couple of weeks ago. That since has ebbed a little bit. We're now back, like you said, in, I guess you can call it a bear market of vol.
let's talk a little bit about what a bull market or a bear market in fear really is. On one aspect, you have spot vol. And I think when people think about this at the most concrete linear way, they're just looking at spot volatility. And so when volatility is low, they say we're in a low vol environment. But when I talk about a bull market for fear, what I'm actually talking about is an expectation of volatility, how much premium people are willing to pay to protect their portfolio, or in a bear market for fear, how little they're willing to pay. So, I mean, the point of this is it's one of the examples I brought out in one of the research papers. In August of 2012, the VIX went down to a 5-year low of 13. And if you wanted to buy a variance swap 1 year out or a VIX future 8 months out, you were going to pay more with the VIX at around 13 than you would have paid the day after Lehman went bankrupt when the VIX was at 31. So in one environment, the VIX is above 30. In the other environment, or we call high vol, the other environment, the VIX is down at 13. But if you wanted to buy forward volatility, you have very, very different pricing. It was actually more expensive to buy forward vol when the VIX was down low than when it was up high right before the 2008 crisis. So this is what I mean by a bull market in fear, a bear market in fear. It's about the expectation of where vol will be in the future, not so much where vol is today. So we came out of 2008, going into 2009, 2010, 2011. The last time I was on the show was after the summer crisis in 2011, and then heading into the first quarter of 2012. We had tremendous fear built into volatility markets. This was the prime time to be playing roll yield, which is where people are selling the volatility term structure on the front and reaping huge returns and premiums for doing it. Now, the reason those premiums existed was because of so much fear that was built into the market. And volatility kept dropping and dropping and dropping. Somewhere along the line, people came into the idea that, hey, you can make a lot of money doing this. People began moving away from products like VXX, this ETF, and they moved away from buying puts and moved away from buying VIX futures, and they started moving into actually selling premium. Now, selling premium has become the dominant strategy. We are in a bear market for fear because anytime there's a small bump up involved, everyone is racing to sell it. And this is the dangerous environment right now if you're a vol seller. You want to be very, very careful right now. We went from an environment where you were compensated for selling vol, which is really, early 2012 in that period, to now an environment where you might still be making money by selling vol, but the risk that you're taking, in my view, is not worth the premium that you're receiving.
You do a lot of work over there looking at the VIX futures and the VIX term structure, and you're right, that usually is in a scenario, a paradigm where you have that excessive premium to long-term VIX futures. That's just the term structure VIX usually has. We're seeing a little bit of a reshaping of that given the recent crazy events we've seen over the past few weeks. But in general, that seems to be the case. You seem to see a lot of premium for the longer-term vol, a.k.a. your bull market for fear there. Why do you think that is in general? Do you think it's just the explosion of alternative players who have come into the space and need to hedge, and so they just gobble up long-term vol in general, and they tend to keep that term structure so steep? Or is there some other underlying mechanic there that's at work that's really keeping that far end of the term structure, usually in most cases pretty steep compared to the front end of the term structure?
Well, I'm not seeing a lot of steepness right now in the term structure.
No, this is one of the few times when you're right. It's pretty much the other way around. But in general, that seems to be usually to be the case.
And what I'm seeing right now is anytime you get a tick up in vol to 16, 17, there's a race to sell the front of the term structure. A massive race to sell the front of the term structure. And this race is being driven by a lot of retail players who are jumping into products like XIV. This builds into for a while, people were compensated after the financial crisis for shorting that roll yield premium. Today, you are not being compensated for doing it. So let me give an example, right? A lot of times when people talk about selling volatility, they compare it, and I think fairly, to insurance. There's this idea that, the insurance business is a good business to be in, right? If car insurance, health insurance, life insurance, you have a certain number of people who are going to get in car accidents, for example. But the reality is that the number of people who need insurance and who don't get into car accidents are going to far outweigh the claims that are paid out on those who do get into accidents. So it becomes a profitable business over time. Well, the economics of that business are driven on the concept that there are more buyers of insurance than sellers of insurance, right? If there are more sellers of the insurance, then the market collapses, and some of those people providing that coverage are going to go bankrupt or are going to get hurt really hard. Well, if we take this and we move this analogy to the options market and the VIX futures market, you have a natural component of people who want portfolio protection, and hence a premium is built into forward volatility curves, and that's where we get this contango element. Well, so many retail investors, just like look up Seeking Alpha and see the number of articles on XIV and short selling VXX. So many retail investors, and I call them vol tourists, have come into this market and pound the front of the curve. Right now, there are literally more sellers than buyers. So VIX put ownership reached a record of 3.2 million in early February. And for the first time in history, the short volatility XIV product had more assets than the long volatility product. So what we're seeing is anytime you get a tick up in the VIX, everyone is betting on mean reversion. It's the Yellen trade. It's going to be okay. It's going to be okay. The Fed will save the day. The market will bounce back. And for 2013, people have been correct in that assessment. Now, that didn't make it a good trade in 2013. You weren't being compensated for the risk, but at the same time, it still made money. But as a result, the premiums have compressed even more. So now whenever you get even a minor spike up in the VIX, you got this flood of short sellers coming on in to short vol, and it's crushing the front of the term structure.
That's a good point, because we're recording this right now, actually February 21st, listeners. Actually, on one of the few days when the market is relatively unched and volatility is relatively unched compared to what we've seen over the past few weeks. Of course, we saw aggressive sell-offs in the market a few weeks ago and then aggressive rallies shortly thereafter. A lot of people leading into those initial sell-offs, that mini correction, I suppose, if you want to call it. There was just a preponderance of interest in VIX upside. We saw a VIX call to put ratio reaching record levels. So people were diving into VIX upside, betting on this some sort of near-term pop. And yet when it finally occurred, when the market sold off, when VIX finally got its little push to the upside, a lot of people lamented that VIX in that environment essentially underperformed. We got into the low 20 handles, but there were bets ranging far higher than that. Now, some of that obviously could be placed on the realm of just ridiculous expectations, but also, would you wager there, Chris, that sounds like a lot of these volatility tourists, as you so call them, were also to blame for that, coming in and actually blasting away at that short part of the curve the second they saw any spark, any life there in VIX?
So, the concept at the end of the day is not return. The concept is return per unit of risk, right? And so whenever I listen to somebody talk about how much money they've made in shorting the front of the roll premium, I sit there and ask them, how much risk are you taking on? What would happen if vol went up to 35? What if it went up to 45? What if it went up above 100 as it did in 1987? Can you calculate and understand that risk? The truth is that when you look at some of these short roll yield products and the premium that people have been getting by shorting roll yield on the front of the term structure, it actually compares very favorably to a 3 to 4 times levered position in the S&P 500. So if someone thinks that they're smart for shorting volatility roll yield, I sit there and say, well, you know what? You would actually get a better return having a 4 times levered position in S&P futures. And they would look at me and they'd say, that's crazy. That's crazy, because I wouldn't lever I wouldn't take a 4 times levered position in the S&P 500. I'd be like, well, that's what you're doing when you're shorting roll yield. You just don't realize it. You don't think about it that way. But if you were looking at it on a risk to return framework, the 4 times levered position in the S&P actually offers a better risk return framework than a 1 times position in XIV does. That was not the case in 2000. That was not the case in early 2012, because the premiums were so much healthier and bigger. But as this has become such a popular trade, the premiums have compressed. Now, if we take this on to a second order, but where does this lead us? Well, people have gotten used to the idea that whenever volatility spikes up, that it's been profitable to short sell vol at those vol spikes. So we've seen that, and that expectation is built into the market every time we have a minor vol event. This has been supported by monetary policy. Actually, to the highest degree in history, not in history, since prior to the crisis in 2008, and one of the highest levels in history, volatility mean reversion as measured by serial correlation. I won't go into the specifics on that, but mean reversion, meaning the propensity for vol to drop after it increases, is actually at some of the highest levels since pre-crisis. This rewards volatility short sellers, as opposed to volatility autocorrelation, where vol goes up in consecutive days, which ends up hurting volatility short sellers. We saw a rebound in vol autocorrelation in December and in January. When you have an environment where VIX goes from 13 to 17, and there's a tremendous number of short sellers that come into the market, volatility tourists jumping into XIV, hedge funds who don't specialize in vol shorting VIX futures on the front of the term structure, collapsing that term structure, inverting that term structure at levels that are 3, 4, 5 points below the historical average for the VIX, you build in this inherent convexity into the market, so that in the event that a crisis follows through and vol keeps rising or autocorrelations keep rising, all those short sellers have to come back and cover their bets. And there's so much energy going in whenever there's even minor vol spikes to cover those short selling bets, that this is resulting in some tremendous upside vol of VIX, more upside vol of VIX than we get downside vol of VIX in this environment. This has occurred where we have not really even had a move in implied vols really north of 21. So you can imagine if we actually get any type of crisis where vol moves from 15 to 30, there's going to be a tremendous and wicked convexity that's going to hit all these short sellers as they all race for the exit at the same time. And this is really the type of market that we're in right now. It presents opportunity for people who are looking to position on the long side of that and are looking to play that dynamic. But I would say it's very, very dangerous right now to be shorting the front of the curve. It might make money. It has made money. That doesn't mean it's smart.
Chris, is one of the reasons why I like to get you on the show. I can just wind you up and you can just go, and it makes my job very easy here on the program, which is great. This is what I love. And don't be offended if down the road I borrow that term volatility tourist. I like that.
No, it's okay. You know what? I'll actually throw out an even better analogy here, right? If you go back to the Great Depression, right? Joe Kennedy was famous for Kennedy came out of the Depression and he did pretty well. He sold off his stocks. And they said, well, why did you sell off your stocks? He said, well, I was getting my shoes signed, and the shoe shine boy was telling me about all the great stocks that he was buying. He said he knew that we were in for a crash when the shoe shine boy was talking about stocks. Well, today, all the shoe shine boys are talking about short volatility. Just jump on any of the blogs or Seeking Alpha. All the shoe shine boys, all the people in the street who have no business trading vol, they're dentists or they're, students studying art history. They're all, short VXX, long XIV. They're all looking to play term structure. What does that tell you right now?
Yeah, the tourists, aka the shoeshine boys, are
The
in full
shoeshine boys
effect. This is actually a good time to have you on the show, Chris, because you're talking a lot about playing in that near term of the VIX term structure. Well, they've just added something new. I think we have just about a week or so under our belts of trading it so far. That is indeed the VXST, the short-term VIX products. We're trying to key off of the S&P 500 weeklies. I'd imagine these will be a home run with these shoeshine boys, aka the vol tourists, that you like to talk about. What's your take so far here on VXST? At least a little bit we've seen of it so far.
I think it's a great product. I'm excited about this product. Like any of the new offerings, there needs to be more liquidity right now. So there's just not the liquidity right now. But VIX started out that way, and gradually liquidity increased. I think that this is a very, very exciting product. VXXT offers significantly more vol to play off of, and I think that's going to benefit people on both ends of the spectrum. There's a tremendous opportunity to play the VXST off of the VIX. I think down the road, these weeklies will actually be, in many ways, more sensitive to the spot VIX than actually some of the longer dated VIX futures are. I think some people will actually be drawn to that sensitivity in a way that they can't get even in the 1 month VIX future. So I think there's a tremendous opportunity for these products. I'm hoping that they succeed. I'm hoping we can see more liquidity in them. I think it's a great addition to the suite of offerings in listed volatility futures, and I'm monitoring them very, very intently. I'd like to see more liquidity in them. I think that'll come with time. I think it'll be a very popular and successful offering once people understand what they can do with these.
And speaking of popular and interesting new products that still may need a little bit of open interest and volume to get going underneath them, we do a lot here on the show with Russell. They, of course, added it to the VIX suite of products. That is, of course, the RVX. I'd imagine this might be interesting for you. I know you're most of your time in the S&P 500 land, and that's kind of where you like to hang your hat from a vol perspective. But looking at the small caps, of course, they do historically have that vol premium to the big, larger cap. So in terms of a vol arb type product, that might be intriguing for you. Have you had a chance to look at these at all?
With Russell, now I actually used to trade Russell vol futures back in the original incarnation pre-financial crisis.
Oh, so you were the one.
Yeah, that's right. That's literally, yeah, because back then you would sit there and post a trade and you would be the one. Yeah. So, and I think that there's a lot of potential for Russell vol, and especially playing Russell vol off S&P vol. That's exciting. I think there's more vol to Russell vol than there is in S&P, and I think there's dynamics between large and small cap stocks that are really exciting. I think a lot of these products. So I'm in favor of it. It's just running a fund with institutional money, you just need liquidity. So that's the issue is trying to popularize some of these alternative vol products. In some ways, I think the VIX products or the volatility product suite is a victim of the success of the VIX. The success of the VIX is wonderful and great. The problem is that a lot of the time, if you're a larger investor in the space looking at listed vol futures, you're going to take basis risk rather than liquidity risk. So volatilities tend to be correlated with one another. S&P vol tends to be correlated with Russell vol, which tends to be correlated with Euro Stoxx vol, which tends to be correlated with Brazilian vol. Across the board, there's some basis differential there, but the volatilities of different equity indices are correlated to one another. So what ends up happening is that people naturally gravitate to the most liquid product, which is VIX, and they're willing to take basis risk to adjust their VIX position to hedge whatever other index may be. They're willing to take basis risk rather than they would take liquidity risk. I really am a proponent, and I would be very excited to see more interest in a Russell vol product. There's tremendous advantages in arbing, Russell against S&P, and in looking at the kind of dynamics of the vol of vol in both of these indices, which are different between one another, and to fully utilize the nuances between large cap and small cap vol. I wish the rest of the investment world would take notice. This is one of those areas where I wish the vol tourist would spend more time on because I think it would benefit the market as a whole. It'd be great if they could actually introduce some sort of an ETF that would add liquidity to these products as well.
Chris, I wish we can keep you on the rest of the show because we have a listener mail question about VIX versus the India VIX and Nifty. And I'd imagine you'd have a few things to weigh in about that as well. But we do have to keep rolling. But before we go, a couple things I want to leave our listeners with. First off, I have to know, are there any more volatility term structure music videos on your future in the near horizon? I think you've made the only one I've ever heard of in my life. If you haven't seen it, listeners, it's a volatility term structure over time set to some funky French techno pop music. It's certainly unique. Any more of those coming down the pike?
We'll see. I'm working on a new research idea. I've kind of taken a hiatus from music video production and research papers, to focus a little bit more on the portfolio. But I think I'd like to release another research paper in the near future. And I just love the idea of visualizing volatility. So you never know. We'll see what might happen down the horizon. I've been really excited for Mansour Adi, the DJ. When I contacted him about using his song, he was kind of just a young up and coming guy, and he's actually opening up for Beyonce now. So
there you go. It was all your vol video that paved the way for him.
Video, right?
When they introduce him ahead of Beyonce, they say, and also the man famous for the soundtrack to Volatility Term Structure. This DJ.
There we go. Right?
Well, I have to say, Chris, as someone who sat in on more than his fair share of these volatility conferences over the years, it wasn't a welcome reprieve to see a music video up on stage for a change. That certainly did mix it up. Speaking of conferences, before we go, are you going to be heading down to the CBOE Risk Management Conference? I know you've been down there in the past. It's coming up next month in March down there in Florida. Are you going to be heading down there?
I am hoping to make it out to that one. If I miss it, it will be the first time, I think, in 4 years. So there might be a scheduling conflict. I'm coming back from London, so I'm really crossing my fingers that I can make it this year. So if not, it'd be the first time in 4 years I don't. It's a wonderful conference for any of the listeners who I think it's the best vol conference of the year because you have a nice cross section of practitioners and academics. So if you really want to learn about volatility, I think this is one that's worth going to. And if I miss it, it'll be my loss. So,
yes, it is a fun show. I like to go when it's here in the States. I've missed the few European ones of late, but I'll be making this one. I love to go there too because, like I've said before, a lot of our Vol Views audience is at that show, and so I'm sure I'll go there. And I hear a lot of people come up to me with all sorts of things they disagree with about what we've talked about on the show. I'm sure, Chris, if anyone disagrees with what you said here, you'll hear about it down at RMC. So it's a great, very lively audience, and we love to have those guys in our audience here on Volatility Views. Really quick before we go, Chris, people want to learn more about what you're doing over there at Artemis, some of the research, and perhaps a music video down the road. Where should they go?
Go to www.artemiscm.com. So, and you can download research and also the music video, which is also posted on YouTube. So, if you just Google Artemis Capital, you'll find me. So.
Great. Well, Chris, thanks for joining us. I'll definitely have to bring you back on again down the road where we can look back at some more of these interesting developments in VIX term structure, and hopefully, definitely sooner than 2 years from now.
Definitely. So, but it's been a lot of fun. So maybe after the next music video. Right?
There we go. Perfect. All right, and that is going to do it for the Volatility Viewpoint segment. And now we're going to keep on rolling right into our Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week that was from a volatility perspective. And to do that, I am joined by my cohort, my partner in crime, the dark side indeed to my light side, none other than Mr. Mark Sebastian from OptionPit.com and Swan Wealth Advisors. Mark, welcome back to the show, sir.
So does that make me Darth Vader?
That makes you, I suppose. Yeah, I guess that would be Darth
Or am I
Vader.
the Emperor?
But then I would have to be the Emperor, I guess, just to keep.
Well, no, you'd be Luke Skywalker. I would be the Emperor.
Problem is, I don't want to be Luke. That's the problem.
Oh, come on.
I want to shoot electrical bolts from my hands, and so that makes me the Emperor.
Well, then you'd be the dark side. I'd be the light side.
That's true. I tell you what, I'll be Boba Fett because he's kind of gray, and then he has all kinds of cool gadgets, and so everyone's happy.
Yeah, but doesn't he end up just like falling into some stupid thing and getting eaten and burnt out?
Yes, pretty much. Not the most auspicious of endings to a great character. All right, thanks for joining us here on This Week in Star Wars. But looking back at the week that was, Mark, we were just talking about it with Chris. I'm curious to get your take on it as well. Of course, probably the biggest development from a vol, and certainly from a vol product standpoint over the past week, was the launch of VXST. We've been talking about it for a while. We finally got something live in some way, shape, or form that we can look at and actually wrap our teeth and sink our teeth into, I should say. What's your take on the first week here for VXST?
Well, the volume's been a little lighter than I would have thought, but it is trading. I'm looking, and they don't have them listed on the SIBO site yet. But I've been told that they're trading, somewhere in the range of 20 to 50 contracts a day.
Yeah, for all the Sturm and Drang over this, it is a damn hard product to find. to actually get a quote for it and see how many are going up.
I'm trying to find the data on it, and they're not posting. They haven't updated the CFE site yet, apparently. But I think those are long term. Once they add options to that play, it's going to be a big deal. I mean, think about it. The VIX futures didn't do anything until they listed options. And then really, they took off once they listed an ETN. But so the VIX futures were doing decent volume against lots of option volume, right? So once they get I think options listed, I think they'll be in much better shape. That's my thoughts.
That's, of course, what a lot of our listeners are looking forward to as well, getting into the actual VXST options as opposed to just the futures. It does sound weird in my own head just to say it out loud, but of course, this is VXST. It's a short-term product, but it's essentially a 4-week strip of products there. So there could even be some interesting term structure going on within VXST itself, which is an odd thing to say, I think, but that'll kind of be interesting to watch as that develops and what people are actually using that for. If we're seeing similar use cases developing to what we see in weekly options, where it's a lot of spreads between the weeks, or what is going on there. But I'll be curious to watch that, if that takes the same kind of general arc we see to the big VIX futures, or if it's kind of its own separate beast.
Yeah, I think it's very interesting. It's very much up in the air. But long term, I think there's a good chance at that being very successful.
Other than VXST, it actually was one of the few less eventful weeks we've had in vol in quite some time, certainly since the beginning of the year. We're actually recording this on a day when everything is essentially unched. So we haven't seen one of those in quite some time. So that's perhaps a bit of nice, refreshing change for a lot of people out there who've been kind of flummoxed by all the volatility we've seen of late. So over the past week, there wasn't really a whole lot of vol action to dive into. Do you think we're kind of in maybe, dare I say it, a bit of a vol malaise, at least until the debt ceiling and some other stuff starts heating up again to maybe kick us up into high gear again?
I don't know. I mean, I feel like vol has been, with this rally, vol's been really firm. I would have expected, up here at 1848, the VIX to be back in the 12s. Instead, it's near 15. I think there's a real chance at, a marketed increase in volatility. They're definitely pricing vol like the market is scared and doesn't like what it's looking at. And I think that's an important thing to be on top of, is that, when you look at the VIX in relative terms, it's way up.
It's interesting, too, that despite the fact that vol hasn't been moving a heck of a lot over the past week, we're still seeing a ton of demand for the products on it, including the VIX options. They're reaching an ADV now of about 700,000 contracts a day, which is just madness when you think back to the early days of that product, that anyone thought it can get to a level like this, where the ADV is 700,000. That's just mind-boggling in and of itself. But I think one of the bigger perhaps more salient trades we saw going up in the vol space over this past week. We actually touched on it a bit on the option block earlier this week. And Mark, you may be familiar with this as well, because I know this is one of your perhaps least favorite products out there. Of course, VXX. We saw a pretty large ratio put spread going up out there. VXX being, of course, the short-term VIX ETN. And we saw rolling out to Jan, the Jan 30-40 1x2 put spread going up about 17,000 by 34,000 times. So it was, of course, selling the 2 to buy the 1, and which is the standard way these ratios tend to work out. But what's your take there on that? Someone putting up that much size in such a long-term VXX put spread. We talked on the show many times in the past about how susceptible that is to roll risk a year out. Jan 30-40 put spread 1x2. It's a bit risky.
Well, I think that's exactly what it is the guy saying, I don't want to deal with volatility. I only want to play roll yield. And that's why you would do a trade like that. I mean, seriously, that's the big piece.
You don't think shorting the 2 a year out on that 30 is a wee bit, given what we've seen historically from VXX, how it performs over time, could come back to bite him? Or you think he's going to put this on and take it off a lot shorter than that? I don't know. I think this is one he could hold for a long time, for a very long time, and potentially through expiration, and it's a pretty big deal, and so I think it's a good trade. It's one that long term is going to pay out very well for the guy, and you just have to, be aware of, as he gets closer and closer expiration, it will turn into more of an issue. It'll turn more into issue. Volatility to start to matter. Really, is what the key is. We also like to delve into the realm of Russell. We talked about it with Chris just now, and he's kind of playing the wait-and-see game with those products, and it seems like the rest of the market is as well. We talked earlier about a lot of open interest going into Feb. A lot of that, of course, expired, and we're waiting to see some more interesting new positioning out there going into March. We're actually seeing some paper going up today, which is interesting. So if we can keep that sort of thing up, then it might be kind of interesting to watch what unfolds. Again, a lot of people are probably doing what Chris is doing out in RVX land and Russell land in general, waiting and seeing for the liquidity to develop a little bit before they dive in to a product like that. Speaking of diving in, it's time for us to dive right on into my personally favorite segment here on the program, because it's your segment. It's, of course, the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, like the man said, a lot of great ways for you guys to get in touch with us here on the old Volatility Views program. And of course, I should also add the mobile app to that. You can click on the old contact tab in there and send us your great questions, comments, feedback, anything you want to share with us here on the old Volatility Views panel. We'd love to hear it. And today's question comes all the way from across the pond. I'm trying to think, this might be our first listener mail from Britain. I know we've had guests from Britain, but never a listener mail. So there we go. You have pride of place here, Mr. Neil Higgins from Birmingham there in the UK. And he writes, what impact, if any, do you think the entrance of China into the options market will have on volatility? Will it spawn a whole nation of VIX call buyers? Also, what's your view on the performance of the India VIX versus S&P 500 VIX? Is it a better barometer of market volatility since it doesn't have all of the ETP baggage that bogs down the US VIX? And he writes, Mark, if you ever take the show on the road to England, let me be the first to offer to buy you a pint. Great stuff all around. Well, thank you for that question there, Mr. Higgins. And I may take you up on that next time I'm over there across the pond. I can always use a nice frosty pint here to lubricate the old vocal cords. A couple of good questions here. Of course, what he's referring to at the top of the question is about the looming entrance of China into the listed options market. They're supposed to be, if everything holds steady on schedule, should be listing options on their exchanges over there sometime in April. I've heard a lot of conflicting things about what those options will actually be comprised of and what they'll be listed on. I've heard crazy things about the government and brokers not wanting people to actually use them that much, so they're putting all sorts of impediments in their way, like having multipliers of 1,000 or even 10,000 on some of these contracts, so they're just so beefy no one could touch them. So I've heard a lot of mixed things, and so given that, I at least in the near term, I'm not too upright on the notion of a whole nation embracing options overnight. If that does indeed come to pass, what I have talked to some of the people I know who do work in that region and do have some derivatives exposure over there say there is a lot of interest over there in kind of opposite of the retail audience here, which is predominantly premium selling, is in premium buying. They like to buy upside. They like to find a stock or an underlying they like and like to load up on out-of-the-money calls and a lot of the things that a lot of retail out here doesn't do as much. So that might be interesting. And we might actually see a lot of, I don't know if there'll be VIX call buyers, maybe VIX put buyers, who knows? But it's an interesting idea. Mark, have you mulled this over at all, what the impending entrance of perhaps 1 billion Chinese options traders could do to the volatility spectrum?
It's not usually volume, other than maybe smooth out some of the pops. Liquidity doesn't necessarily make things less volatile. It just makes things maybe more fluid. So, I think investors like that could cause some fluidity. But then again, if they're not educated properly, and a billion Chinese investors start screwing around with U.S. markets, it can cause all kinds of problems. So I don't know. It's really interesting. I'm not 100% certain what the effect would be, but I'd imagine it'd be marginal.
Yeah, and of course, that'll all be predicated on the fact that these Chinese customers will become educated in options and then gravitate towards the U.S. products, because that, of course, is where the VIX is calculated, and that is what will have the impact on volatility overall, barring, of course, the introduction down the road of some sort of China VIX product or things like that. Speaking of a China VIX, second part of your question here, the performance of the India VIX, which is, of course, on the Nifty over there, versus the S&P 500, is it a better barometer of market vol, since it doesn't have all of the ETP baggage that bogs down the US VIX? This is a more interesting part of the question here as well. I personally don't watch the India VIX that often because it doesn't really do that much, quite frankly. I like what you're implying here about the fact that there isn't this universe of ETPs around VIX, so and theoretically it should be a more pure representation of what's going on, and that Nifty, I believe it's on, or the index that it's on there, and so showing pure implied from that perspective. So in that perspective, you may actually be correct. But I think overall, given the volume, given just the liquidity we see in the U.S. markets, the S&P 500 and the vol coming off of that, overall you have to just lean on the side of the S&P 500, partly because Nifty just doesn't trade enough to really give it the crown of the better barometer of market vol. I don't know, Mark, do you watch the Nifty stuff or the India VIX at all?
The Nifty 50?
Yes.
I get, every once in a while I get emails from somebody in India saying that they trade Nifty, and it's always interesting, but apparently they do way more volume than US option markets. And the volume is much bigger than many people realize. So that's all I really know about the Nifty.
Maybe something we need to add to future shows, the international vol component of our vol review. Because India VIX is one of the few international VIX products that has any real traction. It's not what we see over here, but it's something. So it might be might be a good suggestion here, Neil, for something for us to take under advisement for including here on future programs. As we're speaking right now, the India VIX is at 14.04, the India VIX cash, down about a little over a point today. Whereas in the U.S. markets, of course, we are essentially unched on the day, and VIX is essentially unched as well. So bear that in mind. That's one day's worth of action. But an interesting question. Good one, Neil. And I will take you up on that pint the next time I am over there across the pond. And now it's time for us to keep on rolling into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, this is indeed the portion of the show where we break out the old crystal ball and peer into the future and see what vol may hold in store for us for the coming week. Mark, we touched on this a little bit in the vol review. It's kind of the question now of what is there out there to inject some juice into the markets. You said you thought vol was holding surprisingly steady given what we've seen. It hasn't sold off as aggressively as you might have perhaps expected, which translates into a little bit of an injection of vol into these markets. You think we're going to be hovering here the next time you and I get together to talk about vol, or you think we'll be off to the races somewhere?
I think there's a real chance we could be off to the races. I just watching vol continue to be firm. And I mean, I'll give you a real quick example. Wednesday, we saw the S&P sell off 12 points and the VIX up 1.6 points. All right, call it over 10% for those of you on CNBC that like CNBC. Today and yesterday, we have the S&P basically back up 11, and the VIX has recovered about half of what it gained. So it gave away only half. When you see a market where vol is rallying with the market, or the market is stable and vol is ramping higher, that's almost always a sure sign that something is really unhealthy. And I think that's what we're looking at, and I think there's a real chance that something blows up. I don't know what, but it could happen.
Looking at the options here for a barometer of sentiment, we talked a couple of weeks ago on the show, right before we saw the pronounced sell-off in the markets and the VIX pop up into the 20 handle and above. We saw that call-to-put ratio out there and VIX get ridiculously call heavy, got up to about 3-1. We're not in that range yet. We're only at about 2.4-1. So maybe if you go heavy on the options indicators, we still have a week or so to go of frenzied upside call buying in VIX before we get a pop. But if you go by that indicator, perhaps, then we'll be here again next week. But 2.4-1 is still historically a little strong for VIX. VIX always obviously call heavy to begin with. But when we get to that ridiculous levels, that seems when we're destined to move one way or the other, usually to the upside and usually to underperform, given everything else that we're seeing out there in VIX. All right, that is about all the time we have for the Volatility Views program for this week. But before we go, let me, of course, thank my guest, Christopher Cole. You can find out more about him by searching for Artemis Capital Management, all the interesting research papers. And, of course, you can find that great volatility term structure music video. I know it sounds strange to say. You have to kind of just see it to understand what the heck I'm talking about. You can also find it on the Options Insider. We posted it a couple of years ago, I believe, when he first put it out. It's interesting stuff. And Mr. Sebastian, what do you have cooking there over there in the land of OptionPit.com and Swan Wealth Advisors that may interest our Vol Views audience?
A couple things. So at Option Pit, there's going to be a new set of curriculum rolling out in the next couple of weeks. We've overhauled the gold course, and there should be Andrew's going to be running a chat service soon. At Swan Re, or at Swan, it's all about Swan Re. We're the capital raise on our reinsurance corp is going really well. I was out in New York and in Chicago doing sales meetings last week, and it went really well. And so things are rolling. And I'm not allowed to really talk too much about it, but if you're interested in hearing more about Swan Re, I think there's a website. So it's really exciting what we're up to there.
Yes, that is interesting. Check out SwanWealthAdvisors.com to learn more. Of course, you can also check out our advisors option where Randy Swan was on. Just recorded with him yesterday, and he gave a detailed description of the Swan Reinsurance Company, what it is, how it works, all that fun stuff. So if you're interested in that, it is very much analogous to a lot of the things we talk about here on Volatility Views in terms of risk management and handling that risk premium that you get from an insurance product. It's like an option. So there is a lot of overlap there. So check it out there on the advisors option or head on over to SwanWealthAdvisors.com. And while you're surfing the web, surf on over to Russell.com. Check out what's going on over there in RVX land, as well as all of the other Russell Index products they have cooking up, and some of the interesting things they may have coming down the pike from an options perspective. And on behalf of Mark and Chris, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and for writing in with such great questions from as far away as Britain. Keep it up, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.